Hello, I'm Steve Jones. I'm from Merseyside Pension Fund and welcome to the Local Government Pension Scheme. This session takes approximately 18 minutes and will cover the main topics faced by members of the scheme. In other words, how much it costs, how much you'll get and when you can get it. If you have any questions, please submit them via the chat or Q&A function during the presentation and I'll answer as many as possible. For any I cannot answer, I'll arrange for one of our experts at the fund to contact you. So please leave your name and contact details. So let's get started. The Local Government Pension Scheme is a statutory scheme. In other words, its rules are made by the government and delivered by the Ministry for Housing, Communities and Local Government, the MHCLG. It's a defined benefit scheme, which means that the pension benefits are based on a formula where a proportion of your pay each year is deposited in your pension account, unlike defined contribution schemes where there's a savings pot which is invested in the stock market so its value can go up or down, but this is then used to buy a pension or annuity at retirement. Contributions are tax exempt, so it's a very tax efficient way of saving, and there's an option to take part of your pension as tax-free cash at retirement. While you're building up your pension, its value is adjusted by changes in earnings, and once it's in payment, it's index linked, so it's protected against inflation. There's death in service cover and pensions for eligible surviving dependents, and because it's an occupational scheme, your employer contributes too, on average around twice as much as you do, so it's great value for money. In April 2014, the scheme became based on career average pay, but the pensions for any membership before then will still be calculated on a final salary basis at retirement, using different formulae and rates, which I'll go into more detail on in a few slides' time. Since April 2014, 1/49th of the pay you earn each year is deposited in your pension account and then adjusted the following years depending on how earnings change each year. There's an option for anybody finding it difficult to afford their contributions to pay half their normal amount. This is called the 50/50 option. But obviously, while paying half, the pension being built up would only be worth half as much. The normal pension age, when you can voluntarily draw unreduced benefits, is now the same as your individual state retirement age. However, for pre-2014 membership, this remains as age 65. The earliest you can draw your pension is age 55, previously being age 60. But remember, the earlier you voluntarily take your pension, the higher the adjustment or reduction will be, on account of your pension being paid for longer than expected. How much does it cost? How much you pay is based on how much you earn, but for main scheme membership can be anywhere between 5.5% and 12.5% of your pay. However, were you to decide to take the 50/50 option, this would then be anywhere between 2.75% and 6.25% instead. If you work part-time, the rate you pay is based on your actual earnings, not what the full-time equivalent would be. So here are the bands and rates for both the main and 50/50 sections of the scheme for the rest of this financial year. So how is your pension calculated? Depending on when you joined, your pension could be calculated in up to 3 parts. For pre-2008 membership, using your final year's pay or the best of your last 3 years based on 1/80th with an automatic lump sum. For membership between April 2008 and March 2014, again using your final year's pay or the best of your last 3 years, but for pension only, based on 1/60th per year. And finally, For membership after March 2014, a pension based on 1/49th of your pay for each year until retirement, but again with no automatic lump sum. So, if you joined the scheme after March 2008, there would be no automatic lump sum, but there is an option to give up part of your pension for one, or to increase it if you joined before 2008. So let's take an example for someone, say, earning £24,500. In year one, they would bank an annual pension of £500. However, this amount doesn't stay at £500. If we assume that public sector pay freezes continue and that inflation is 2%, at the end of year two, that £500 is increased by 2%, or £10, and is added to the £500 added in year two. And this continues until you leave or retire. And if you take the 50-50 option, the principle is exactly the same, although the pension build-up is half of those shown here. To get an idea of how your pension is building up, why not register for our online service, My Pension? Once registered, you'll be able to see the annual statements we produce every August. However, please remember, if you're considering retirement, request an estimate from your pension officer instead, as the annual statement is only an illustration and the figures shown are on the understanding that they are not drawn earlier than expected. It's really important that you view your annual statements because they also show the annual pay figure which your employer has given to us. And if that's not accurate, you'll need to let your employer know so that they can advise the fund. While the basic scheme provides excellent benefits, you can decide to pay more than your usual contributions to increase your income at retirement. And there are two ways you can do this: in-house, with tax-exempt deductions directly from your wages, APCs or additional pension contributions, and AVCs or additional voluntary contributions. But you may need independent financial advice to decide which is the best option and which one matches your circumstances. Just to give you a rough idea, here's a summary of how APCs work for you to look at later. And now here's AVCs. Unfortunately, we're not able to advise you on which you might pay. However, if you contact the fund on 0151 242 1371, they can give you more details. Alternatively, visit our website at mpfmembers.org.uk. So when can your pension be paid? Only 1 in 10 of us carry on working until at least state pension age. So how are the other 90% retiring? Let's look at the main reasons. Firstly, we have ill health. For a pension to be paid on an ill health retirement, your employer must first arrange for you to attend a medical with their independent registered medical practitioner, or IRMP for short. In addition to assessing your ability to permanently carry out your job until your state pension age, the IRMP will determine when you might be able to perform other gainful employment, in other words, working at least 30 hours a week for 12 months or more. If you are deemed permanently incapable, then, depending on when the IRMP considers you fit to perform other gainful employment, will determine the tier of ill health retirement your employer might grant you. If it's determined that you could never be expected to work again before your state pension age, your pension would be enhanced, increasing the total value to the amount you would have received had you continued working and paying into the pension scheme until your state pension age. This is a Tier 1 ill health retirement. Alternatively, if it's found that you could only be expected to work again after a period of 3 years since your retirement, whilst your pension would be enhanced, the enhancement would increase the total by only 25% of the amount you would have had had you continued working and paying into the scheme until state pension age. This is a Tier 2 ill health retirement. Finally, if it's determined that you could be expected to work again within 3 years of retirement, your pension would not be enhanced, but would be paid unreduced for up to 3 years, with a review halfway through after 18 months to assess your condition again. At this point, your pension might either be uplifted to a Tier 2 if your original condition has worsened to the point that the IRMP deems you would no longer be able to perform gainful employment until after 3 years, or terminated if your condition no longer makes you permanently incapable, or terminated if you are in gainful employment, or finally, it will be continued at the original rate for the remainder of the 3 years, at which time your pension would then end, unless you reach or have reached your state pension age within that time. Employers occasionally look for budget savings by offering staff the opportunity to volunteer for early retirement on the grounds of redundancy or business efficiency, although as the cost for each individual is different, not everyone who applies is selected. The earliest a member can be retired in these circumstances is their 55th birthday. As far as the pension scheme is concerned, there's no difference between voluntary and compulsory redundancy. However, new scheme regulations are currently awaited, which will potentially affect how benefits can be paid in these circumstances, on account of the introduction of a payment exit cap of £95,000, which is likely to take account of redundancy payments and the pension strain amounts employers have to pay to allow benefits to be paid early. So watch this space. Anyone made redundant under 55 is not entitled to draw their benefits, but can do so at 55, although their now deferred benefits would be paid with an early retirement adjustment. Flexible retirement is a fairly new addition to the scheme rules. It allows employers to use their discretion in allowing those staff aged 55 and over to draw their benefits whilst remaining in employment, albeit in a reduced capacity. In other words, on either fewer working hours or on a lower paid, perhaps less stressful job. The thinking behind flexible retirement is that it gives staff an opportunity to have a gradual move to retirement rather than a cliff-edged one, where their finances are not necessarily affected despite either working less or in a less stressful, lower paid job. Employers too may benefit, as the flexibly retired member then has the chance to pass on their knowledge to the new staff member working the hours the member gave up, rather than leaving completely and taking their knowledge and experience with them. It's something you have to apply for and may not be granted. Ultimately, it's up to your employer to use their discretion, and each employer will have their own policy for this. By far the most common retirement reason is voluntary retirement. Between the ages of 55 and 75, members can choose to leave and draw their pension benefits. However, the earlier they leave, the greater will be the adjustment or reduction on account of the pension being in payment for significantly longer than expected, in other words, from their normal or state pension age. Certain members who first joined the scheme before October 2006 may satisfy something called the 85-year rule by the time they retire, which can protect some of the benefits against early retirement adjustments, but I'll tell you more about that on the next slide. However, each member is different, and with this in mind, if you're considering voluntary retirement, you'd be wise to request an estimate of your benefits from your employer first. So what is the 85-year rule? Well, to satisfy the 85-year rule, you must have, by your intended retirement date, a total age plus total scheme membership equaling at least 85. However, this can only protect some of your pension benefits against the early retirement adjustments. If you joined the scheme late and would never satisfy the rule at your state pension age even, then retiring voluntarily before then would mean all of your benefits would be subject to the early payment adjustment. If you satisfy the rule before age 60 and wish to retire before age 60, you would need your employer's discretion to have the protections applied. Here's a summary of the rule of 85. However, I must repeat, if you are considering voluntary retirement, it would be wise for you to request an estimate of your benefits from your employer before making a decision to retire. So what happens if you leave your job before retirement? Well, if you leave your current employment but have yet to complete 2 years service, the only options you would have would be to take either a refund of the contributions you paid whilst in the scheme, which would be subject to a 20% tax deduction, or to transfer the pension to another pension scheme, perhaps your next employer, although you will need to authorise their pension provider to contact us to request a transfer value. If, however, you've completed 2 years membership, you may either transfer your pension to a new pension provider or leave it with us as a deferred pension, which can then be paid from as early as age 55. But what happens to your pension if you die? As a scheme member, you provide benefits payable on your death. I'm sure you're all aware of the 3 times annual pay death grant payable should you die before retirement. But how many of you have completed an expression of wish form? We'll send you one with the pension calculation at retirement. This is still important as we have a 10-year pension guarantee, which means if you die within 10 years of retiring, and this occurs before you reach age 75, we can pay the difference between what you have received and 10 years worth of pension. There are also pensions for eligible spouses or partners and dependent children. However, if you're not married, your surviving partner would need to provide official evidence of at least 2 years cohabitation at the time of your death. And that concludes this short introduction to the local government pension scheme. Here are some useful contact details for the fund and some other websites which you may find useful. Thank you for listening.